This is a training session, the training session for day 3. And our topic of discussion this morning will be on financial planning and bookkeeping. I have already been introduced by the coordinator of this program. So I'll just mention my name. My name is Oheru Chechuku. I'll be the facilitator for today's training. So it's expected that at the end of this training session, which will last for about 2 hours, thereabout, you, the participants, have to maintain their financial records for identify bookkeeping methods, the various bookkeeping methods available to us. Accounting. At the same time, we shall also see how financial records, financial transactions are being recorded in our books. Then lastly, we'll try to see if we can balance the accounts or balance our books. I understand that most of us may not have accounting knowledge. Navigates or how these accounts, the financial reports, are to be balanced or what it looks like. So I'll be sharing with us towards the tail end of this session format of financial reports so that we can all be abreast of it. So emphasis here is on financial planning and bookkeeping. So we are not to dwell much on the financial account preparation. No, it is just how to maintain our bookkeeping. So it's expected that you learn the simple techniques for maintaining your books as business owners, as companies, CEOs or company accountants and so forth. So let me start off by telling you this, this saying that you can't run a healthy, successful business without having your books in order. It's practically impossible for you to run a healthy and successful business if your books attempt to do that, you will be likened to a man who drives a car without a fuel gauge or map. And you know what happens when somebody drives a car without a fuel gauge or map? The person will discover any moment that he has run out of fuel because he has no gauge, no fuel gauge to tell the level of fuel. And when your fuel runs out, just like it happened to somebody I know, Jodadi, you'll be forced to push the car aside, or you call a towing van to tow the car. This same analogy applies to businesses in real estate. The moment you cannot plan your finances for the business and you cannot maintain adequate financial records for the business for you to track all your activities, believe me, that business may tend not to operate efficiently or effectively as the case may be. So that's the more reason why you have to familiarize yourself with financial planning processes or activities, as well as bookkeeping processes. So let's start off by looking at financial planning. Why financial planning? Why the need for financial planning? And what is financial planning? Financial planning is a plan needed for estimating the fund requirements of a business and determining the sources for the same. Any plan that is undertaken in order for you to ascertain how much that is needed for the proposed business of yours to be launched That activity, we refer to it as financial planning. You have decided to go into business, you want to go into business, needed in terms of fund requirement, how much in terms of naira and kobo that you need for the business to thrive, for the business to operate efficiently. That's what we refer to as financial planning. You know you want to go into business, how much in terms of naira and kobo is needed for that business of yours to thrive or to be set up. And having identified how much that is needed for the business, the sources, I mean, where the money will be gotten from. You need to identify where the funds will be gotten from. So all of these activities is what we refer to financial planning. So one, identifying the fund requirements, how much is needed for the business to be set up. And two, also identifying where, in terms of the source, where the funds will be gotten from. So essentially, financial planning it includes generating a financial blueprint for companies future activities. So in an attempt to generate for your company's activity, that's what we refer to as financial planning. So here are some of the objectives of financial planning. These are some of the reasons why companies, why individuals engage in financial planning activities. Number one is to ensure availability of funds. The more reason why you have to undertake a financial planning activity is to ensure that funds are readily available for your business. Like I said earlier, you need to make sure that that business of yours, the ideas you have conceived, for you to translate it to reality, for you to put it into action, you have to back it up with what? Funding. So ensuring that funds are available. This is number one cardinal objective of financial planning, why companies engage in financial planning activities. Secondly, time and source of funds, estimating the time and source of funds. Having identified how much is needed in terms of naira and kobo for the business to be set up, you need to also establish the timing when the money will be needed for injection into the proposed business. Also, the sources where the money should be gotten from. I mean, should the money be taken from a money market? Should it be taken from a microfinance bank, a nicer microfinance bank, just like most of you anticipating to get these loans from nicer microfinance bank? Can it be taken from a friend or any commercial bank? So the source where these funds will be gotten from is also very important. And these are some of the activities that you have to consider when planning your finances, when engaging in financial planning. And also the timing that the funds will be needed for injection into the business is also very critical. Let me say here that for every fund that is injected into a business, there's what we call finance cost of capital. Most of you will know it as interest on borrowing. So for every fund that is injected into a business, there is attendant cost of capital. Even if the fund is not taken as a loan, be it a fund that you have saved up and you have injected into the business, there is always what we call cost of capital. The cost of capital is that fund you have saved over the years and injected into the business can also be put into another business venture to earn you returns on investment. So even the funds you have injected into the business and the funds you have saved personally, the funds you have borrowed from any lending institution, organization, all of them have attendant cost of capital. And for you to keep this cost of capital, cost of borrowing, interest element to its barest minimum, you need to time when these funds are to be injected into the business. It's not just enough for you to take up funds. You have been able to source these funds from the approving authority, maybe nicer microfinance bank, and you have it sitting idle or lying idle in your bank account. that does not make any business sense, because as the funds are being held idle in your bank account, you will keep servicing the attendant interest that the fund is meant to bear. So we must also the timing and the source of the fund. It is very, very critical. Then thirdly, generating capital structure is another objective why companies engage in financial planning, why business owners indulge in financial planning activities. What then is capital structure? When we talk of capital structure is the total fund injection into the business. For every fund that is injected into a business, the fund is either coming from what we call equity or debt. Equity or debt. Every fund, let me make an instance. You do know that you need 10 million naira for injection into the business for you to set up the proposed business. That 10 million naira is the total fund requirement for the business. And out of that 10 million, if you are able to generate, let's say 6 million out of the 10 million, that 6 million is what we call equity, meaning it is a fund contribution by the owners of the business, the shareholders themselves, and those we call equity participants. That's the 6 million. And the balance of 4 million that is needed to make up the 10 million, that balance of 4 million that you probably have to borrow, maybe from National Microfinance Bank or any commercial bank or money market, any lending institution, that 4 million is what we call debt. So every fund that is injected into a business either constitutes either debt or equity. So equity is the portion that is contributed by the owners of the company, while debt is the other portion that has to be borrowed from any lending institution. So generating a very good capital structure is important in planning your finances. Why is it so? Yes, loans are very important. Loans are very good. But if you don't plan your loan and if you don't gauge the loan, there is what we call gearing. You discover that your business becomes totally or highly geared. And that will not be good for any business. When your business is highly geared, it means that the total fund injected into the business is made up of majorly debts, that's loans. Imagine having to invest 10 million naira and 80% of the 10 million, which is about 8 million, is coming as borrowing, as debts, loans you have taken up. And you're only contributing 2 million out of that 10 million. It doesn't say well about the business. Because if you allow your capital structure to be totally weighed up or to be dominated majorly by debts, by liability, you discover that you are putting the business at risk. The business is being exposed. Exposure in terms of liquidation, exposure in terms of takeover, and all that. Because those you are owing the 8 million or that amount, the loan amount, any attempt when you fail to make payment of the interest or the principal sum that is due to them, your business is subject to takeover. Your business is exposed to risk of takeover. And no rational investor will want his business to be taken over by creditors, the people you are owing. So that's why the capital structure is very important for you to decide. You need to decide a very good capital structure that works for you, and preferably always ensuring that your equity, the amount of funds contributed by you, the shareholders, exceeds the amount of loan that you have taken up. So that's what we mean by generating a capital structure. And lastly, the objective of financial planning is avoiding unnecessary funds. Recall I told us earlier that every fund that is taken for injection into a business, has attendant cost of capital. That's the interest, the borrowing cost. So in order for you to avoid the interest, to bring or cut down the interest element, the cost of capital, you need to time when these funds are needed for injection into the business. Such timing will help you minimize the cost, of borrowing. So, like I said earlier, even if it is the fund you have contributed, you have saved over time that you want to deploy into this business, also has its own cost of borrowing. We call it cost of capital. So we do everything possible to bring this cost to their barest minimum, because it is practically impossible for you to get loans, free or zero rates, zero interest loans. So you have to do the calculation and ensure that the funds are only taken up when they are needed for injection into the proposed business. So these are some of the objectives why companies, why business owners indulge in financial planning activities. So there are basically two types of financial plans. We have the long-term, sometimes we call it strategic financial plans, and the other one is the short-term operating financial plans. So let's look at them one after the other. We'll start off by looking at the long-term strategic financial plans. The long-term financial plans consider a number of financial activities, which include activities like one, proposed fixed asset investments, research and development activities, marketing and product development, capital structure, sources of financing. Okay, let me give examples using maybe one out of these activities. The first we have here, one of the activities that is covered under the long-term financial plans is proposed fixed asset investments. What then is fixed asset investments? Fixed assets are those resources that are needed by a company for capital, for revenue generation. So in other words, we say they are assets that are deployed into the business. And these assets, in most cases, are expected to live beyond one accounting year, meaning that the assets may last up to 12 months or 1 year. It can last up to 3 years, 4 years, and all that. So this is a clear, simple definition of fixed assets. Imagine if you are involved in farming activities, you're a farmer, you're involved in farming activities. One of your fixed asset investment that will help you earn revenue, earn sales, earn income will be maybe your tractor. A tractor is a good example of fixed assets for a farmer. So that tractor, if you, the business owner, you are considering how to purchase these fixed assets, we are talking of proposed fixed asset investment. You are considering how to invest in these fixed assets. So the options available to you, the business owner, will be one, either to buy this fixed asset, that's this tractor, outrightly. If you have the liquidity, the cash, you have the cash. So you can buy these assets outrightly by walking up to any distributor, any dealer of this particular tractor. You pay cash and the tractor is delivered to you. That's one of the options available to you. The second option for financing this tractor will be maybe going into what we call a finance lease, hire purchase arrangement, where you go into an arrangement to be paying for this tractor, this proposed tractor, over a period of time. So these are the options available to you, the business owner, either to buy this asset outrightly or to go into a finance lease that allows you to pay instrumentally. So in an attempt to take any of these decisions, we say that the company is carrying out what we call long-term financial plans. That's why we say proposed fixed asset investment is under the long-term financial plan. Then activities that borders on research and development, markets and product development, where a company is trying to develop a product or prototype for each business. So these fall under long-term, what is referred to as strategic financial plan. Then the capital structure, I've talked about it before, where we said the capital structure of a company requires the business owners deciding on what proportion of the total fund requirement will come as equity, that's the capital contribution by the owners of the business, and what balance will come as loan, where I gave an example using the 10 million naira fund requirement. And we said, if out of the 10 million, 6 million naira is contributed as equity by owners of the business, it therefore means that the balance of the 4 million to make it 10, which is needed for injection into the business, will definitely come as a loan, as a debt. So deciding on the capital structure. Any attempt for a company to decide on the capital structure that its business should operate, that is referred to as long-term financial plans. It's referred to as long-term financial plan. Then sources of financing. This is sources of financing. So this is clearly deciding on where the funds, the financing are to be gotten from. So all of these activities, like we have highlighted, fall under the long-term strategy financial plans. So these plans are generally supported by a series of annual budgets and profit plans. Another way you can know that a plan is of a long-term financial plan is when you consider the time frame, the time period that the plan is meant to cover. If a plan is drawn up for a period of 3 years and above, you do know that such plan is a long-term strategic financial plan. So in other words, for you to identify that a plan is of a long-term financial plan, you may need to consider the time frame, the period that the plan covers. So having a plan that addresses concerns, financial concerns or issues for a period of 3 years and above, it suggests that that type of plan is a long-term strategic financial plan. Even as these plans are drawn up for 3 years period, there is every tendency, every likelihood that the plans will still be broken down into what we call annual budgets and profit plans. So it is these annual budgets and profit plans that cumulatively, when you group them together, when you sum them, will make up the long-term financial plans. So the second type of financial plan is the short-term operating financial plan. Short-term operating financial plan. Either you call it short-term financial plans or you call it operating financial plan. It's called operating financial plans because it covers a short period of time, a period of 1 to 2 operating periods. So short-term operating financial plans specify short-term financial actions and the anticipated impact of those actions. And typically, it covers a 1 to 2 year operating period, just like I said earlier. So this chapter and the next 3 chapters focuses on short-term financial plans. A good example of short-term financial plans would be management of your company's working capital. When you have a company and you have working capital, what is referred to as working capital? Working capital are those assets and liabilities which can either be converted to cash or lead to cash leakage, cash outflow within a period of 12 months. So a good example of working capital management for the assets, the current assets, if a company is considering how to manage its current assets, example of those current assets are its receivables, its inventories, and so on. So let me give you an instance, a specific instance. So if you are considering on how to manage your receivable, who are receivables? Receivables are debtors. Who are debtors? Debtors are those customers who are owing your company. So if a customer buys on credit from you and the customer is promising to pay at an agreed future date, that customer, that debtor, is who we refer to as a receivable. So that amount, you may be considering available options to you, which is either to allow the debtor to owe you for a maximum period of 1 month, or give a grace period of 2 months, meaning that the debtor can owe you for as much as 2 months or maximum 1 month. So trying to decide on all of this and how long you want to be owed or how long your company should be owed, these constitute what we call short-term operating financial plans. Short-term operating financial plans. Likewise, you have your inventory. Inventories are stocks. When you have your inventories, your stocks, you are considering how to manage your inventories. How well can you manage your inventories? Should your inventories immediately you have bought them, do you sell them as they are, or you add some value into it by making it go through some processing activities, maybe turning it from raw material to finished goods before eventually you sell it. So taking all of these decisions borders on short-term financial plans. So, like I said earlier, short-term financial plans addresses issues or concern that borders on what we call working capital, which is a company's current assets and a company's current liabilities. And for you to know that plan is of a short-term financial plans, you need to consider the time frame that the plan covers. If the plan is usually for a 1 year period or 2 years period, then you know that such plan is a short-term operating financial plan. Okay, so we have talked about financial planning, and for us to attain this financial planning objective, for every company to attain the financial planning objective, the company will use a particular tool which we call cash budget. Cash budget is very, very useful. It's a critical tool that is used for financial planning activities. So what is cash budget? Cash budget is a statement of a firm's planned inflows and outflows of cash. So any statement of a company that clearly itemizes all the inflows in terms of revenue, income that the company will earn. We're talking of cash income, the ones that are paid or received by the customer, by the clients. That's what we refer to as inflows, cash inflows. Meaning, if a customer buys from your company and the customer is owing you, that is considered as receivable, and we don't consider them in the cash budget. So emphasis here is on movement of cash. All the cash you have been able to collect as a result of your sales activity, that will form your cash inflow, total inflow. All the amount you have been able to spend in terms of expenditures or your purchases, the total cash you have paid out, that will constitute the cash outflows. So aggregating all of these cash inflows, how much you have generated, and cash outflows, which is how much you have paid out, in a statement, that statement is referred to as a cash budget. So it's expected as a rational businessman or woman, as an investor, it is expected and normal that when we prepare our cash budgets, the total inflows, total cash collections in terms of your cash sales or cash revenue must always exceed your cash outflow or your cash purchases. Nobody will want to incur cost or spend more than the person has generated. It doesn't make any business sense. So sometimes, yes, due to liquidity problems, a company may have negative cash flow, what we refer to as shortfall or cash flow deficit, where the outflow, total payment, is more than the total inflow, total receipt. But it is advisable that we strive to maintain a surplus cash budget. A surplus cash budget connotes that all the total cash inflows are more than total cash outflows. So cash budget, don't forget, is very useful. It's a very important tool for planning our finances, for financial planning. And usually the cash budgets are prepared monthly. And even as you have the monthly cash budgets, you go ahead to prepare, they are translated into the annual budgets. So you can have a monthly budget, and from the monthly budget, you now have the annual budget. So here is what we call a budgeting cycle. This is the cycle that is expected of every business owner while carrying out the budgeting process. So this is a typical cycle for budgeting. Number one, performance planning. Number one is performance planning. You have to plan your performances. And when we talk about performance planning, what do we refer to? We are talking of deciding the objectives or goal for the business. Performance planning, deciding on the objective or goal for your business. That's what we refer to as performance planning. So for you to carry out your budgeting activity, you need to decide on the objective or the goal of the business. Let me give you an instance. Maybe you want to go into farming this particular season, and your performance planning, your objective, your goal for this farming season may be, after the end of the farming season, I want to have 10 tons of maize. Perhaps you are planting maize for the planting season. So the 10 ton of maize, which is your focus, your objective, we call it objective. That is your goal for the farming season. So performance planning, like we said earlier, is deciding on the goal or the objective of the business. So the objective from the example I've given you now is that we want to have 10 tons of maize after the farming season. So clearly you have identified your objective for that business period, that business cycle. Then secondly, you provide a frame of reference. A frame of reference simply means benchmarking. You need to benchmark your goals, meaning there has to be a reference point. You don't just say you want 10 tons of maize. There has to be a benchmark. Some of those benchmarks would be, maybe you have done earlier assessments that suggest that for you to have 10 tons of maize after the farming season, you need to have at least 5 hectares of land, meaning on the average, 1 hectare of land will probably yield you 2 tons of maize. So that by the time you multiply 2 tons of maize by the 5 hectares you are planting, all things being equal, your objective, which is 10 tons of maize, becomes feasible. So you need to provide a frame of reference, a benchmark that is realistic. It's not just enough for you to have a goal. The frame of reference also has to be realistic, because nobody sets a budget objective that at the end of the day, the budget becomes very difficult to be attained. Your budget should be attainable budgets. And that's why your objectives also must be attainable. Imagine somebody saying, oh, from 1 hectare of land, I want to have 10 tons of maize. I want to harvest 10 tons of maize. That is totally impossible. Those who have farmed over the years will tell you that the average you can get, if you're a farmer, if you have farmed very well, the average ton you can get on a particular hectare of farmland, if all things go very well, will be between 1 ton, 1.5 ton, or maximum 2 tons. So based on this realistic benchmark, you are now setting your objective, which is how we arrived at the 10 tons of maize. So the benchmark, the frame of reference, has to be realistic, has to be attainable, so that you don't set budgets that are unattainable. Then the third step will be carrying out the implementation or the execution of the budget. So what is the execution in this instance, in this scenario that I have mentioned? The implementation will be going into the farming proper, where we have to mobilize those who plant the maize on the farmland, 5 hectares of land, plant it, carry out the weeding activities, spray pesticides and all that, apply fertilizers and all that. So this is the implementation proper. And after the implementation is done, you now carry out investigating variations. We investigate variations. Variations, when you are engaged in budgeting, variations are bound to happen, meaning you can have variances. Variances between what you actually budgeted and what the results turned out to be. So in this case, don't forget, our objective, our budgets, our performance planning, we said our objective was to have 10 tons of maize after the farming season. It may be that after the farming season, you're able to harvest 7 tons of maize. You now see that there's a difference between the actual result, which is 7 tons, against the initial objective, initial plan you have set, which was 10 tons. So you see there is a shortfall now of 3 tons. You planned for 10 tons, and eventually you are now having 7 tons as the outcome. So you see that there's a variance. So the variance can either be favorable or adverse. Your variation can either be favorable or variance. Favorable means that, yes, the result or the outcome of your budgeting activity supports the initial plan you have set. While if it is adverse or unfavorable, it means that the result falls short of your initial objective you have set. So investigating the variations, part of the activities that you may now consider in investigating the variations will be checking to see the possible causes why the 10 tons of maize was never possible. Why is it that you budgeted for 10 tons of maize, which was your objective, and eventually you harvested only 7 tons of maize? So you launch investigation into the possible cause of the variances. And some of those investigations will be probing to know if planting was done early enough. Was planting done early enough? Like some of us will say, if you want to plant maize, plant it around July or maximum August. Did you plant around that time? These are some of the investigations that you have to launch. You may also ask, did you use, while farming, did you use the right seedlings? The seedlings you use, are they good? Were they good? So these are some of the, then you also consider other activities like the farm implements you use, the fertilizers and all that, the herbicides and all that, were they of the good quality? So these are some of the activities you have to launch while investigating the possible cause of the variation, of the variance. And the other step is take corrective actions. You put actions that will help you forestall the reoccurrence of the negative variance or the unfavorable variance, the adverse variance that you initially witnessed. In other words, those things you didn't do well during the execution, during the implementation of the farming period, you probably strive to do them better. Maybe next farming season, you try to plant earlier. Next farming season, you try to use a good seedling, the right seedling for maize, for planting. You try to use the right farm implements, like the fertilizers and all that. So these are some of the corrective actions that help to forestall the reoccurrence of the adverse budget. And finally, which is the last on the list, you now plan again. Planning is a continuous process. When we plan for the first time, we plan again. So that's why we said it is a continuous process. So we tend to plan over and over again. So planning can be annual, it can be monthly, but do know that planning is a continuous process. So these are some of the budgeting cycles, budgeting processes that you may have to take while planning or budgeting for your finances. So have what we call strategy planning and budgets. There are basically two types of strategy. We have the long-run strategy and short-run strategy. Sometimes we call it long-run plan and short-run plan. So remember, anything that is long, meaning that the period is for a extended period of time. So when you have a long-run plan, it means that the plan covers a period of 3 years and above, just like we mentioned under the long-term financial plans. So when you have a long-run plan or a long-term strategy, the best tool to use in addressing the long-run plan will be drawing up a long-run budget as well. You may need to use a long-run budget to address the long-run strategy or long-run plan. If you also have a short-run plan, those plans that covers a period of 1 to 2 years, like we said earlier, the best tool available to you in addressing these long-run plans will be to deploy short-run budgets. So short-run plans are best addressed using short-run budgets. Long-run plans are best addressed using long-run budgets. So that's what we mean by the strategy. Depending on whatever strategy you have, if the strategy is for a longer period of time, you may need to deploy the long-run budget. But if it's just for a very little time, maybe 1 month, 2 months, 3 months, 1 year, or max 2 years, you may need to deploy the short-run budgets. There's what we call cycle of money. The primary function of finance is the movement of money from lenders to borrowers and back again. This is referred to as cycle of money. Money moves, money rotates, money comes into the business and leaves the business. So imagine the proposed business that you want to go into. If NISAL eventually approves your loan. It means that your accounts will be credited, the company's account will be credited. And the moment your company account is credited, it means that the company has received funds. Money comes into the business through this loan. And as the money comes into the business due to your borrowing activities, you then use those money to pay for goods or services. You will pay vendors or your suppliers, those who provide you with one form of goods or services. You will pay salaries and wages to your employees, those who are on permanent employment, even your casual worker. So you discover that the money which has come into the business is now finding its way out again by the time you start making these payments. And when you make these payments, because you don't just pay people for doing nothing, they're either supplying you with goods or services, be it your supplier, be it your vendor. You are getting goods or services in return. Likewise, your employees, you get goods or services in return. And these goods or services that you have paid for, even though the money has gone out when you make this payment, you discover that those goods or services, you eventually sell them. You sell them. And once these goods are sold, customers pay again to you. The money comes back to the business. So you see, the same money that came in, either through NASA Microfinance Bank or fund injection by yourself, the equity participants, find its way out when you start making payment for goods or services supplied to you by either vendors or your employees. And the same money returns back again by the time the goods or services are available and you sell them or you render them to your customer. So this is what we call cycle of money, meaning that money tends to rotate, to move in and out of the business. And that's what we call it, the cycle of money. So let's consider another section, which is the bookkeeping section. Bookkeeping involves the recording on a daily basis of a company's financial transactions. When we talk of bookkeeping, we are referring to the whole activity of trying to document on a daily basis all the financial transactions of your business. In other words, we are saying for every naira and kobo that passes through your business, it should be recorded, it should be documented. There should be appropriate books for every transactions in your business. That's what we refer to as bookkeeping. When you pay money to customers, when you pay money to your suppliers, when you pay money to your employees, you record it. When you incur costs, you record it. When you make sales, you record it. When you generate income, you record it. When you pay back the loan, you record it. When you collect the loan at first, you record it. All of these activities is what we call financial transactions. And trying to document them, trying to provide adequate books for them is what we call bookkeeping. So with proper bookkeeping, companies are able to track all information on these books to make key operating, investing, and financing decisions. The major reason why companies maintain their financial records is to help them take adequate decisions that borders on operating, investing, and financing activities. It's only in this part of the world, as in Nigeria, that most companies probably keep their books simply because they don't want to be harassed by the tax authorities or regulatory authorities. But in actual sense, even if the tax authorities are not to visit you, you are meant to maintain your financial records, your bookkeeping, to help you take key, informed, strategic decisions that will impact positively on your business. I'll tell you some of those objectives, some of those importance of bookkeeping in our next slide. So bookkeepers, you may need the services of bookkeepers if you cannot individually maintain the books yourself. So bookkeepers are individuals who manage all financial data for companies. Without bookkeepers, companies would not be aware of their current financial position, as well as the transactions that occur within the company. So when you don't have bookkeepers, those we refer to as account clerks, or if you have the finances, you can go for an accountant, a qualified accountant. So if you don't have these bookkeepers, these account clerks, don't worry, there are ways you can independently maintain the bookkeeping activities for yourself. So any moment from now, I'll share with us how we as non-accountants can individually, personally maintain our financial records. But if you can afford it, it is most advisable that you engage the services of an account clerk or a bookkeeper or a qualified accountant who will help you better manage your financial records. So here are some of the importance of bookkeeping. These are some of the reasons why companies engage in bookkeeping activities. Number one, to provide a reliable measure of a company's performance. Companies maintain their bookkeeping activities in order to measure how well the company has fared over a particular period. You may want to know how much profit your company recorded in prior year, maybe last year, 2019, and this year, 2020. You want to know, has there been any improvement in the company's performance in terms of profitability being reported? Then you need to maintain your, you need to keep your records. So this is the number one cardinal objective for bookkeeping, why you need to maintain your financial record to help you assess your company's performance, if your company is making progress or not, if there is a decline or weakness in your financial activities. That's number one. Number two, bookkeeping provides information for strategic decision. When you maintain your bookkeeping, you are better informed. You can take what we call strategic decisions as business owners. Let me give you an instance. Some of these strategic decisions that you may be taking as business owners. So imagine if you are involved in farming activity, and this farming activity, you have various segments. Maybe one of the segments, you say, okay, one of the segments, I want to farm crops. And the other segment, second segment, I want to farm animals. So one of the segments, which is crop farming, the other segment is animal farming. You may want to take strategic decisions that borders on assessing which of these operating segments is bringing adequate or commensurate returns to the business. Maybe after the farming season, you may need to check how much revenue did you earn from the crop cultivation, and how much revenue did you earn from the animal farming? How much return in terms of profitability did you make from the crop farming? And how much revenue, how much profitability did you make from the animal farming? So having assessed all of this, because you have been able to keep your financial record, you can take some of the strategic decisions which may border on assuming the crop cultivation yielded you little or no return like you envisaged. Maybe it wasn't profitable like you imagined, the crop cultivation. You can say, okay, I don't want to continue with this crop cultivation. Meaning next farming season, I don't want to go into crop cultivation. All energy, all resources will now be channeled to the animal farming. These are some of the strategic decisions that you are bound to take when you maintain your bookkeeping. Then the other one is providing benchmark for revenue and income goals. When a company maintains its bookkeeping activity, the company is able to benchmark its revenue. The company is able to identify its revenue earning activities, and they vigorously go after them. So when you maintain your financial records, you definitely know those potential income earning activities, and you chase them to ensure that they are attained. Then fourthly, fulfillment of legal and tax obligations. When you maintain your bookkeeping activity, you better comply with legal and tax obligations. Like I said before now, most people in this part of the world, which is Nigeria, they maintain their financial records, they maintain their bookkeeping because they want to pay or comply with the tax authorities. They want to pay taxes. That's the only reason why people prepare financial statements, but it goes beyond that. Your main objective for maintaining your books, your financial record, should go beyond complying with legal and statutory obligations, paying your taxes. It should go beyond that. And we have seen instances where companies were forced to pay taxes even when they were not liable to tax. Companies that make losses within their first 3 years of operation, if you are new into a business and you make losses within the first 3 years of your commencement, it's expected that you will be exempted, automatically exempted from tax payments. But I've seen instances where these companies eventually paid taxes to the tax authority, be it FIRS or your state inland revenue where you reside, where the income was generated. They were forced to pay taxes. Why do you think they were forced to pay taxes? They paid taxes because there were no records to substantiate that they have made losses for this period, and as such, should be exempted from tax payments. So once you don't have your bookkeeping, once you don't have your financial records in place, you discover that you may assume some tax liabilities, which ordinarily you wouldn't have paid because you have failed to keep your financial records. Then another importance of bookkeeping is providing stewardship to investors. In modern day business, you discover that investors differ from the managers. Investors are the owners of the business, just like you, who want to commit your funds into the proposed business. If you have to engage managers who will run this business on a day-to-day, the managers, you expect them to provide you what? To provide you with stewardship, accountability function, meaning they have to provide reports to you. And the only way the managers can provide this stewardship function, because they have been entrusted with the day-to-day administration of the business, is by providing their books of account. So they need to maintain these financial records for them to be able to provide, to account for how well they have run this business on behalf of the owners, those referred to as investors. And lastly, proper management of cash flows. When you have a good bookkeeping system, you maintain your financial records, you are properly able to manage your cash flows. Your cash flows are better managed. You clearly see those activities that probably were not budgeted for, so that you can do what? You can totally avoid them. Those activities, those expenditures that are not necessary for you to earn revenue, so that you can avoid them. And by so doing, you manage your cash flow. So these are some of the importance of bookkeeping, reasons why companies engage in bookkeeping activities. So let's consider what we call accounting basis. Accounting basis. Accounting basis refers to the time period that accounting transactions are to be recorded. If accounting transaction takes place in the business, at what point should these accounting transactions be recorded? Should it be when you have been paid? Take, for instance, you have sold your goods. Should it be when you are paid? Eventually, the customer decides not to pay immediately. The customer owes you for 1 month. Should that deter you from recording your accounting transaction? Should you wait until the funds have been received before you record this accounting transaction? Or should you record it even as you are waiting payment? So this is what we refer to as accounting basis. The time frame, the time period that accounting transactions are to be recorded. So we have basically two types of accounting basis. We have what we call the cash basis of accounting and the accrual basis of accounting. The cash basis of accounting, under the cash basis of accounting, accounting transactions are only recorded when cash is actually received or paid. So when a company uses the cash basis of accounting, the company only records accounting transactions when there is movement of money, when money comes into the business or when money leaves the business. Meaning, if there is no movement of cash in or out of the business, that accounting transaction will not be recorded. The accounting transaction will not be recorded. That's why it's called cash basis. Emphasis here is on cash movement. As cash comes in to the business, you record the transaction. As cash goes out of the business, you record the transaction. So let me give you an instance. Imagine selling your goods on credit and the customer of yours is promising to make payment in 1 month's time. The fact remains, as the goods have been sold, because you operate using the cash basis, as you have sold the goods, you have to wait until 1 month's time when the cash is eventually received from your customer for you to book that accounting transaction. But if, on the other hand, you have to record the accounting transaction, not necessarily waiting until the cash is received, it therefore means you are using the accrual basis of accounting. So under the accrual basis of accounting transactions are recorded when they occur, even if cash is not received or paid. So when a company uses the accrual basis of accounting, emphasis here is not on the cash movement, whether the cash has come into the business or has left the business. No, emphasis here is on the occurrence of that particular transaction. So like the instance I gave, the other example I gave, where you have supplied your goods to a particular customer and the customer is promising to make payments to you in 1 month's time. The question is, has this transaction occurred for you to record it under the accrual basis? The answer is yes. For you to allow a customer go home, part away with your goods, with your product, it means that that transaction has crystallized. The exchange has taken place. So in this case, the transaction has occurred. And as such, you have to record that transaction using the accrual basis, irrespective of the fact that money has not been received. So under the accrual basis, we don't pay attention to the movement of money, rather we pay attention to the occurrence or non-occurrence of the transaction. So I believe you should know the difference between the two now. The cash basis, where we said we only record accounting transactions when funds have been received or paid. But under the accrual basis of accounting, transactions are recorded when they occur, even if cash has not been received or paid. So occurrence here is the key word for accrual basis, while for the cash basis, cash received or cash payment is the watchword for you to take note. So there is an example before us. You purchase 100 units of a product and you will pay for it next month. You have purchased 100 units of products and payment is due for next month. So now, if you are using the cash basis of accounting, remember under the cash basis of accounting, we said once the funds have not been paid or received, no accounting transaction is recorded. So in this case, for the fact that you are using the cash basis and payment will be made next month, it therefore means no accounting transaction will be booked or recorded. You will rather wait until 1 month's time when the money is eventually paid before you can record the accounting transaction. But if, on the other hand, you use the accrual basis to record your transactions, for you to have received the 100 units of this product, it means that the exchange, the transaction has occurred, because no supplier will want to supply you these goods if the transaction will not materialize. So in this case, the transaction has materialized. The transaction has occurred. So under the accrual basis, even as you are yet to make payments, for the fact that the transaction has materialized, has occurred, you go ahead and book this transaction in your books. You record them. So you now see the difference between the cash basis of accounting and the accrual basis of accounting. And let me state here that any of the accounting basis that is adopted by you for your business is expected that that basis will have to be applied consistently. Please take notes. If you are using the cash basis of accounting for your year one in business. Maybe you eventually commence the proposed business of yours in the year 2021, and you use the cash basis of accounting for your financial statement, recording your financial statement for 2021. It's expected that 2022, 2023, as far as that business is in operation, you will continue to use the cash basis of accounting. If eventually you decide to use the accrual basis of accounting for year one, it's expected that years to come, if you use accrual basis in the year 2021, you feel that is more suitable for you, as you have used it in 2021, it's expected that 2022, 2023, and other years to come, as far as the business is still in operation, you will continue to use the accrual basis of accounting. So in accounting, switch between these accounting bases is totally forbidden. You cannot switch from cash basis of accounting to accrual basis of accounting year in, year out. It's totally forbidden. It's expected that any of the accounting basis that is adopted will have to be applied consistently. When you adopt any of these accounting basis, you have to apply it consistently. Consistent application is a word here. Don't use cash basis this year, and next year you want to use accrual basis, and the other year you'll come back again to cash basis. Any attempt to do that will make your financial statement incomparable. The financial statement for 2 years, any user of the financial information may not be able to compare this financial statement. So endeavor that anyone that is adopted by you will have to be applied consistently, please. So here we have methods of bookkeeping. There are 2 methods of bookkeeping. We have the single entry bookkeeping method. We have the single entry bookkeeping method and the double entry bookkeeping method. Single entry bookkeeping method and the double entry bookkeeping method. Recall I told us at the beginning of this training session that even as non-accountants, I will show you ways to maintain your financial records, your bookkeeping as non-accountants. So non-accountant, the single entry bookkeeping method will appeal most to you having no accounting background, no accounting knowledge. So under the single entry bookkeeping, it is straightforward method where one entry is made for each transaction in the books. Only one entry is made in the books. How does this work? You may decide to have a hard cover notebook that you record all your financial transactions. That is a bookkeeping in its simplest form, where you have a hard cover notebook, you segment them, you say, okay, if I make sales, I will record it under this section of this notebook that I maintain. If we incur expenses, we'll record it under these sections and all that. So that is a bookkeeping method on its own, and it is straightforward. It is straightforward. Don't need to bother yourself with which account to be debited and which account is to be credited. It's a bookkeeping method in its simplest form. Like some people will have what we call, some people will buy cash book analysis column cash book. Usually sold at the bookstore. Analysis column cash book is more like a register. It has various columns segmented and drawn, where you decide, okay, for this column, this first column, I want to be recording all my sales. If I make all sales, I will book them under this column. If I pay for salaries, I'll book them under the other column. If I pay for transport expenses, I'll book them under the other column. If I incur hotel expenses, I'll book them under the other column. If I carry out to repair and maintenance expenses, I'll book them under the other column. So that also is a way, a simplified way of maintaining bookkeeping. So that is an example of single entry bookkeeping method on its own that you can deploy for your business, even as non-accountants. And remember here, emphasis is on bookkeeping, not on financial reporting. They are 2 different things. We are saying maintain your books, maintain your financial record, so that a qualified accountant can come in upon your invitation. Having maintained this book, you can invite a qualified accountant to pick these records you have maintained, these records you have kept, thereof produce financial reports from it. When you call a financial accountant, a qualified accountant, be it an auditor, to prepare your report, financial report, and you don't even have the basis, the books of accounts, no record was maintained, you totally agree with me that what the account, the financial reports that will be generated by this qualified accountant will be inaccurate. You cannot take any decision with it. You cannot make any investment decision with it. But when you have successfully maintained all these records over the period you are reporting, then a qualified accountant can take it up from there and generate your financial report thereof. Another way I also see people, once they make payments, they pay through check, they cut checks of the company to either their suppliers, vendors, employees in for payment of one goods or services that they have received. As they cut the checks, they write it down on the check stub, the small leaf that is still attached to the check booklet. They write all the details of that transaction, the narration. Imagine if they have to pay salary and they issue it through check. They will write the details of that. They will write on the check stub that this payment relates to salary for a particular month for this amount, and they put the dates. That is a simple bookkeeping method on its own that is straightforward, that you as a non-accountant can even deploy. Now let's look at the double entry bookkeeping method. If you are not using the single entry bookkeeping method, you definitely be using the double entry bookkeeping method. Under the double entry bookkeeping method, it is more robust. It follows the principle that every transaction affects at least two accounts, and they are recorded as debit and credit. So when a company uses the double entry bookkeeping method, it means that for one transaction that takes place, that transaction will be recorded into two places. We'll call it the debit entry and the credit entry. And for anybody to use the double entry bookkeeping method, that person will have to possess some background, accounting background or knowledge for the person to understand which accounts to be debited and which accounts to be credited. And like I said, if the double entry will be a headache to you, it's most advisable that you use the single entry bookkeeping. But if you can afford the services of an account clerk or a bookkeeper or a qualified accountant, then the qualified accountant can then deploy the double entry bookkeeping methods. For anyone that works for you, to advise that you deploy it and use it rigorously, follow it religiously. So here is an example. If you sell a bag of cowpea, that's beans, for 20,000 naira, you sell a bag of cowpea for 20,000 naira, the transaction will be debit the cowpea, debit the bank, sorry. If you have received the amount through bank, you debit the bank. If you have received it through cash, maybe you have been paid cash, you debit the cash account. Then the credit will be the sales account because you have eventually made sales. So this is what we, in a simple form, this is what we call the debit and credit of a transaction. So you see, just for the sale of this cowpea, which is one transaction, you can see that we have booked it into two entries. Sometimes, even when a transaction happens, it can even have multiple entries. It can have up to 3 or 4 entries, depending on the nature of the transaction. But like I said, if these cannot work for you, maybe you cannot get the services of a bookkeeper and account clerk, you are strongly advised to stick to the single entry bookkeeping method. Accounting systems. Accounting systems are designed to document and report on financial transactions affecting business. Accounting systems, any attempt to make designs that helps a company collect, document, and report on financial transactions affecting businesses will refer to that process as an accounting system. So the whole essence of trying to set up your analysis column cash book, setting up the check stub, that enables you document these transactions whenever they occur, setting up the register, maybe cash book register that you fill in all the transactions as they occur. All of those processes is what we call accounting systems. So when you put structures in place to help you collect all financial information as transactions occur within the business, that process is what we refer to as setting up accounting systems. It is said that you have established an accounting system. So these accounting systems can either be manual or computerized. An accounting system is said to be manual if it is being processed by hand. So any accounting system that we have to rely on the use of hands, just like creating the analysis column cash book, where you go to the analysis column cash book, you record these transactions as they occur, you have your hardcover notebook, you record these transactions as they occur. All of these processes is a manual accounting system because these accounting transactions are being processed by hands. So if you're not processing your accounting transactions by hand, then definitely you are relying on the use of computer. So if an accounting system is not manually inclined, then it is computerized accounting system. What then is computerized accounting system? The computerized accounting system, financial information is recorded by entering it into a computer. So when you rely on the use of computer to maintain your accounting system, to maintain your accounting transactions, it means that the accounting system so far deployed is computerized accounting system. Like some people will deploy accounting software like Sage on their systems. The Sage helps them to post these accounting transactions. The Sage will help them post these accounting transactions. Some may use QuickBooks, some may use Tally to post this accounting transaction with the help of their computer systems. Some may even use ordinary Excel, what is known as spreadsheets, the Excel. You book all your transactions in the Excel. These are the computerized accounting systems because you are relying on the use of computer to maintain this accounting information. Why do you need to know that since there are so many computer programs out there, you can use them? Have you ever heard of the saying, garbage in, garbage out? I don't know if you have heard of the saying, GIGO, we call it GIGO, garbage in, garbage out. You have to understand the basic bookkeeping behind what you enter into the computer program in order to enter in the correct information. So the fact that you are using a computer system does not mean that you will not have a little or basic accounting or bookkeeping knowledge. Because even as you rely on the system, if you don't have accounting, little or basic accounting knowledge that tells you under which category should this particular transaction be booked, you discover that even the computerized accounting system may tend to be inaccurate when the financial reports are produced. So simply say, the computerized accounting systems are not totally from error. They are not totally free from error. The computerized accounting system, the fact that you're using a computer does not preclude that transaction or your financial report from having error. But the kind of error here will be man-made error. Like I said, garbage in, garbage out. If you wrongly key in an information, maybe instead of posting a particular transaction, instead of posting it under salaries and wages, you now post it under transport expenses. You discover that the two account balances, which is salaries and wages account balance and transport balance, will be what? Inaccurate when you produce your accounting report. So the point we're trying to make here is that even as we rely on the use of computer to maintain our financial records, to keep our books, we still need to be thorough. We still need to be careful. We still need to feed the right information into the computer system. So still under the accounting system, there's what we call GAAP, Generally Accepted Accounting Principles. There's what we call GAAP, Generally Accepted Accounting Principles. All accountants use the same set of rules to prepare financial reports. Okay. So all accountants use the same set of rules to prepare financial reports. This set of rules are being issued by Financial Reporting Council of Nigeria, FRCN. It is the FRCN, Financial Reporting Council of Nigeria, that issues all of these rules, of which accountants are expected to abide by. So there are rules, there are policies, there are regulations which we must comply with while maintaining our records, our financial records. Reason being that when you leave this bookkeeping and accounting unguided, there are no regulations to guide accountants in the way and manner these transactions should be recorded, you discover that it will be subject to abuse. It will be subject to abuse. There are various users of a financial report. I'll tell us who those users are any moment from now. Various users of financial reports. I'll tell us who the users are. So each of these users have their information needs. So you don't prepare account to serve a particular user of the financial report. No, your account must be seen to be faithfully represented, meaning as the figures are, that is how you are reporting them. There shouldn't be any form of manipulation. And in order to guard against this manipulation, what we call window dressing and creative accounting, that's why the Financial Reporting Council of Nigeria came up with this GAAP, Generally Accepted Accounting Principles, of which all accountants must abide by while preparing their financial statements, while preparing their financial reports. You have to abide by the provisions of the Financial Reporting Council of Nigeria, these rules. Let me give you an instance. Imagine a business owner who do not want to pay tax, doesn't want to pay tax. Business owner, you agree with me what the business owner is likely to do? They try to tweak the accounts such that there will be little or no profit for the year. I know once you don't have any profit, reported profit for the year, it means you are totally exempted from tax payments. Or you may want to suppress the income for the year so that the taxes also are suppressed. He pays a little tax. So in order to guide all of this, that's why there is generally accepted accounting principles that accountants will have to follow. Another manager whose reward system is incentive-based will want to do everything possible to report adequate or enough profit so that you can enjoy the profit for that period. You can enjoy the incentive, the bonus for that year. So in order to prevent all of this window dressing and creative accounting, accountants, bookkeepers need to follow the provisions of the generally accepted accounting principles as issued by FRCN. There's what we call financial reports. Financial report is the end product of our bookkeeping activities. So having maintained the bookkeeping activities, it's expected that financial reports are produced thereof. So the bookkeeping activities you have maintained, the best thing for you to do, if you can prepare it, fine. But you cannot prepare account for yourself. You cannot vet the account yourself. You may probably rely on external accountants, external auditors to vet the accounts. So the account that is produced from the bookkeeping activity you have maintained, that account will refer to it as financial reports. So bookkeeping will have to be maintained first, then from the bookkeeping is translated into financial reports. So financial report is summarized information about the financial status of a business. It tells you the summarized information about the business. Can we see accounting is the language of business. Accounting is the language of business because it is so fundamental to the communication of financial information. Accounting is often called the language of business because accounting tends to document every naira and kobo that passes through an organization, that passes through a business. That's why it's called the language of business. So we have basically two broad categories of accounting reports. We have the financial accounting and the management accounting. What is the difference between the two? Financial accounting focuses on reporting information to external users. Financial accounting reports information to external users. Those we consider external users are those who are not owners of the company or who are not involved in the management of the company, external users. So the next slide, I will tell us who the examples of both external and internal users. So if any account is prepared exclusively for use by external users, those who are not members of the company, that report, that accounting report, we call it financial account. But if, on the other hand, these accounting reports are prepared to focus on reporting information to management, often referred to as accounting for internal users of accounting information, that accounting report, we call it management account. So any account that is prepared for use by the owners of the company and the managers, those who are involved in the day-to-day administration of the business, that accounting report is referred to as management account. But if that account will have to go outside the business premises to serve the needs of external users, those who are not members of the business or who have no management of the business, who are not involved in the management of the business, that account, we call it financial account. So here are examples of external users. External users are individuals outside the business who have an interest in the business. So those individuals who are not members of the company, who are not within the internal workings of the business, but rely on any accounting report, any financial report that is produced, they are called external users. A good example of external users are government entities. A good example of government entities that may be interested in your accounting report will be a tax authority, maybe FIRS, Federal Inland Revenue Service, your state Inland Revenue Service. They will be interested in whatever accounting reports that you prepare. If you are involved in an activity that is being regulated, take for instance, you are into insurance business, NICOM, National Insurance Commission, will be interested in your financial report. If you're interested in pension businesses, maybe you carry a pension business, you're a PFA, pension fund administrator, your account will have to be submitted to National Pension Commission. These are government authorities that are meant to receive your accounting report. The second is the general public. General public, your account can only be made public if you are a public liability company, if your shares are being listed on the floors of the Nigerian Stock Exchange, meaning your shares are being traded, then your financial statements will be made public. A good example is Dangote PLC. Dangote PLC has its shares trading on the floor of the Nigerian Stock Exchange. Kono PLC, Julius Berger PLC, so Zenith Bank PLC and all that. So all these PLCs, their financial statements are to be made available to the general public. Civil societies, you may have some civil societies, NGOs who may be interested in your financial statement for one form of reason or the other. Then the lenders. Lenders is also an example of external user. Lenders, those who are provided you with one form of funding or the other. A good example of lender in this case will be NISA Microfinance Bank. So if NISA Microfinance Bank eventually advances you the loan that you are seeking, then it means your financial statement will have to be made available to NISA Microfinance Bank when they call for it. So lenders. So all of these are examples of external users. Now let's consider the internal users, those who are either owners of the company or within the workings, internal management of the company. A good example is the shareholders, the owners of the company, just like you listening. The business is yours. You are the shareholder, so you are considered to be an internal user. The managers, those who are involved in the administration of the business. The managers, the examples of internal users. The employees also, they are examples of internal users. Your staff, the employees, because they will at some point refer to this financial statement. They will need this financial statement to see how far they have fared during the period. So here is what we call accounting reports. Here are examples of accounting reports. The various accounting reports that we're expected to produce from our bookkeeping activities will include one, balance sheets, income statement, cash flow statements. Balance sheets, income statement, cash flow statements. What is balance sheet? Balance sheet is any statement that highlights what belongs to a company and what the company owes third parties. So any statement that shows what we call assets, resources belonging to a company, as well as what the company owes outsiders, those the company have borrowed from, that statement is referred to as a balance sheet. So balance sheet is generally prepared in order to assess the financial position of a company. That's why we prepare balance sheet. And the components of balance sheet, when we prepare our balance sheet statement, the components of balance sheet will be assets, liabilities, and equity. Assets, liabilities, and equity. So there is what we call balance sheet equation. And the balance sheet equation is that the assets must equal liabilities and equity put together. The total value of the assets in your company. Assets are those resources belonging to your company which you use to generate revenue. That's what we refer to as assets. So your total assets must be equal to your liabilities and equity. We've talked about liabilities and equity. Equity is a fund contribution by the owners of the business. Why we said liabilities are amounts borrowed from those who are not members of the business. So let me give you an instance. If the total value of all your assets in the business, all your motor vehicle, furniture and equipment, plant and machinery, your inventory, that's your stocks, your receivable, your cash in the bank, these are assets belonging to your business, which you use for your day-to-day revenue earning activity. Those are your assets. So if the total value of this asset is 10 million, it means that this asset would have been funded by either equity or liability. Meaning, when I add equity and liability together, I'm expected to have the same 10 million with the value of the asset. That's what we mean by balance sheet equation. In other words, it means that this asset we have mentioned that is valued at 10 million, maybe 6 million had been contributed by the owners of the business, which is what we call equity. And definitely the balance of 4 million would have probably come as a liability, a borrowing. That's what we mean by balance sheet equation. So at every given point in time, liabilities plus equity put together must equal the value of the asset. Then income statement. Income statement. Income statement is a statement that is prepared to show the profitability of a company. So companies prepare income statement in order to see how profitable they have been over a particular period. So how do you prepare income statements? You aggregate all your sales. I will show us samples of both balance sheets, a format of balance sheet and income statement. So you aggregate all your sales, you minus all your expenditures for the period. So it's expected that your sales will either be greater than your expenditures, leaving you with a profit, or on the other hand, if your expenditures are more than your sales, it leaves you with a loss. So that's why this statement is sometimes called profit or loss account, meaning is an account, is a statement that is prepared in order for you to assess if you have made profit or loss in any particular period. Income statement. Then the other one, the third one, is a cash flow statement. Cash flow is a statement that is prepared to assess the liquidity position of a company. When we prepare cash flow statement, we want to assess the liquidity position of a company. We want to assess how liquid the company is. What do we mean by liquidity? Liquidity is the ability of a company to meet up with its short-term debts when they fall due. How liquid are you? How much do you have in your bank account? As a business owner, as a company, do you have enough resources in the bank such that when debtors, when creditors, those you have borrowed from, when they come knocking at your door, you are able to pay those amounts you have borrowed? That's what we mean in a simple form as liquidity. Ability to settle your short-term debts when they immediately fall due. So when you settle your debts, when they fall due, it means you are judged to be liquid. But if you are not liquid, it means you struggle to pay your debts when they fall due. They start chasing you up and down, asking you to pay, that the time has elapsed. It means the company is not liquid. So when we prepare cash flow statements, we aggregate all the cash inflows, all the cash collections by the business owner, by the business itself, all the cash collections. Then we minus all the cash outflow, that's cash payments. It leaves us with either cash surplus or cash deficit. Cash surplus suggests that all your cash inflows exceed your cash outflow, meaning how much you have collected during the year generated in terms of cash sales exceed how much you have eventually paid out. But if on the other hand, all your cash outflow, the amount you have paid out to vendors and employees exceed the total cash inflow, how much you have generated, means you have a deficit cash flow statement. So every rational investor would always want to have a surplus cash flow statement, meaning that the total inflows exceed the total cash outflows. So don't forget, cash flow statement is prepared to assess the liquidity position of a company. You want to see how liquid a company is. It's quite different from income statement. Income statement is to assess profitability of a company. So profitability and liquidity are two different things altogether. So here is a balance sheet equation. The equation I talked about, where we said imagine the total assets being 10 million. It therefore means that the liability and equity, when we sum them up, should also give us 10 million, like the value of the assets. So if the value of your company, all the assets in your position, which you use in running your company, the motor vehicle, plant and machinery, your generator, your office furnitures and all that, your computer laptops, all of them are worth 10 million. They are considered to be your assets. It therefore means that all these assets we have mentioned that is valued at 10 million would have been probably been bought through equity, the capital contribution by shareholders, that's the equity, and partly liability. So it's either out of this 10 million value of your assets, 6 million has been brought in as equity by the shareholders, and the balance of 4 million definitely constitutes liability, borrowings, loans you have taken in order to finance this asset. So that's why we said liability and equity put together must equal the value of your assets. Then income statements, like we said earlier, you aggregate all the revenue, then you minus all expenditure. So it leaves you with either profit or loss. Profit or loss. You have profit when the revenue exceeds the expenditure. You have loss when the expenditure exceeds the revenue. Every businessman or woman, every rational investor would always want the revenue to exceed the expenditures. So here is a sample of a balance sheet. There is a sample of a balance sheet, a format of a balance sheet. You will see the left column, you will see the total assets. Left column records all the assets, while the right column records the liabilities and equity. And if you check the total, the balances total of both the left and right column, you discover that they are equal. They are equal. Of them are equal. That's what we mean by your total asset. The value of your asset must equal the value of your equity and liability. So assets, just like you have noticed, assets are categorized into two broad categories. We have the current assets and the non-current assets. So your asset can either be current assets or non-current assets. When is it a current asset? It is a current asset if those items belonging to you can easily be converted to cash within 12 months. Then you categorize it under current assets. So if you watch carefully, you will see under the current assets, we have stuff like cash and cash equivalents of 100,000 as the cash in hand, cash at bank. Accounts receivable of 20,000 naira. Account receivables are debtor balances, the amounts you have sold on credit, those who are owing you, they are your assets, they are your resources. 20,000 naira. Inventory, what is known as stock. Stock. So because this inventory, this stock is expected to be converted to cash within 12 months, that's why it comes under current assets. Likewise, the account receivable, those who are owing you this amount, who are bought on credit and they're owing, is expected that they will pay within the next 12 months. That's why it's categorized under current assets. Then prepaid expenses, any amount you pay in advance for goods or services you are yet to enjoy, we call them prepaid expenses. Example, when you pay rent in advance, that rent is called prepaid rent. When you pay rent in advance, we call it prepaid rent. So sometimes we are required to pay rent for 2 years. So imagine if you have paid rent for 2 years and year 1 comes to an end. That of year 2, which you have handed over to the landlord, but you have not enjoyed the goods or services, the services for that facility, it will be treated as prepaid expenses. That's prepaid rent. It's an asset to you, rent asset. Then investment, any investment that has maturity of 12 months, any investment that is due to mature within the next 12 months, meaning it can be converted back to cash within 12 months. That investment will be categorized under current assets. Then under the non-current assets, we have property, plant, and equipment. Property, plant, and equipment are those resources belonging to a company which is used for revenue generation and they are expected to live above 1 accounting year. So when you have any asset that is meant to live beyond 1 financial year, that asset is categorized under property, plant, and equipment, and you use it for revenue generation. Example, land and building. Building improvement. When you have lands, when you have building improvement, your land ordinarily is expected to live for several years. So for the fact that the period exceeds 1 accounting period, 1 accounting year, you categorize them under property, plant, and equipment. You can have plant and machinery, which is your generator. If you have office equipment, motor vehicle, all of them, because these items we have mentioned are expected to last over 1 year, they become categorized under non-current assets. The another type of non-current assets other than property, plant, and equipment is what we call intangible assets. Intangible assets are non-monetary items without physical substance. Non-monetary items without physical substance. So anything, any assets that helps you to generate revenue or sales or income that you cannot see, feel, or touch it, we call it intangible assets. Example, what asset can you have that you cannot see, feel, or touch it, but you use it to generate income or revenue? Perhaps you have a license, a fishing license, that gives you the right to fish in a particular river. That license, you cannot see, feel, or touch it, but it helps you in generating revenue. That's a clear, good example of intangible assets. Maybe you have a computer software that has been installed into your system. That software is an intangible asset. You cannot see the software, you cannot feel it, you cannot touch it, but you use the software for revenue generation. So these are the categories of assets. And don't forget, ladies and gentlemen, that assets are categorized into two broad categories. Current assets, that's those assets that can be converted to cash within 12 months, they come under the current assets. And the non-current assets, those that cannot be converted to cash within 12 months. Examples, property, plant, and equipment, intangible assets, and the likes. Now move on to the right section, which is liabilities and equity. So under the liabilities are further subdivided into two categories: the current liabilities and the non-current liabilities. Current liabilities are those indebtedness of a company which are due for settlement within the next 12 months. So when this company, like this company, we see the name on this balance sheet, 30 Fab Incorporation. If 30 Fab Incorporation is owing some people due to its business dealings with the people, this company is now owing outsiders. Those people 30 Fab Incorporation is owing, they are referred to as liabilities. They are referred to as liabilities. So under the current liabilities, those indebtedness that 30 Fab, that's this company, must pay or settle within the next 12 months, they are categorized under current liability. Accounts payables is a good example of current liability. Accounts payables, where the company is owing some people who have supplied them with goods or services, but they are yet to pay for it. Accounts payables. Maybe 30 Fab had bought goods or services on credit. It's a liability, a current liability. It's due to be settled within the next 12 months, so it comes under current liability. Notes payable, when they take loans, the portion of the loan that is due for settlement within the next 12 months comes under current liability. Accrued expenses, they have enjoyed goods or services, but they are yet to pay for it. Maybe salaries being owed, they will come under this accrued expenses liability, which must be settled within the next 12 months. Deferred revenue. Maybe this company has collected revenue, sales, but it has not discharged the responsibility. Maybe when you collect money from customers and you have not supplied the goods or services for which the revenue is meant, it will come under current liability. The liability is assumed that you are owing whoever you have collected that money from until the goods are supplied before it ceases to be treated as a liability. Then under the non-current liabilities, sorry, the heading is not clearly shown, but under the non-current liabilities, you have long-term debts. That's loans, long-term debts. Long-term debts are those liabilities of a company which can be settled over one accounting year, over 12 months, meaning that the indebtedness can last even up to 2 years, 3 years, and so forth. A good example of long-term debt will be the NISAL microfinance loan you want to take. If eventually these loans are advanced to you, because the loans you are not expected to pay back within the next 12 months, will be categorized or will be classified under the long-term debts, non-current liabilities. It will come under the non-current liability. Then after the liabilities, we'll go on to the shareholders' equity. Under the shareholders' equity, they are those account balances that belong to owners of the company, shareholders themselves, which is the common stock. We call it ordinary share capital, additional paid-in capital. Sometimes we call it director's current account, any amount that they contribute other than what is registered in the corporation document. their retained earnings, all accumulated profit or losses over the years that the business has been in operation. So these balances are what we refer to as shareholders' equity. So like you can see, the total assets on the left column, which is 472,000. The last figures there on the left column, total assets, 472,100. You can see it is equal to the total liabilities on the right-hand side, which is 472,100. 472,100. So you can see that the total assets, which is the last figures on this sheet, both of them are equal. That's why we said your total asset must equal the total equities and liabilities put together. So here is a sample of income statement. This is what an income statement looks like. When you prepare income statement, you see, look at the sales. It's expected that we categorize all the sales earning activity, just like we have here. The sales earning activity, you can see client service revenue, book sales, professional consultation, then it gives you total sales. So the same thing applies. When you have various sales earning or income earning activities, it's expected that you list all the earning activity to help those who are reading this account make or take adequate informed decision. Imagine if you are involved in farming various products, it's expected that once you realize your revenue from these various products, maybe you cultivated yam during the year, it's expected that you show revenue from yam cultivation. You cultivated maize, it's expected that you show revenue from maize cultivation. You cultivated cowpea, you will show revenue from cowpea cultivation. The essence is so that those who are studying this account will know which of these sales earning activity performed the most during the year. So after that, we have all the expenditures. All expenditures that is incurred for you to earn these sales, this income, you aggregate them, just like we can see, wages and salaries, marketing and advertisement, rent, utilities, depending on the kind of expenditure that appeal to your business, you aggregate them, you sum them up. So the total expenditures are then deducted from the total sales, leaving you with profit or loss before tax, after which you now make provision for income taxes, and you will be left with profit after tax. The last figures there, we call them profit after tax. The last figures on this screen, we call them profit after tax. I want you to also observe that even as the current year is 2004, the year under consideration for this account, this income statement we're looking at is 2004. You can also notice that 2003 financial information are also placed alongside with the current year. So when you prepare income statement, it's expected that you have the current year, in this case, which is 2004, and you should also have the comparative year, which in this case is 2003. The whole essence of having a comparative figure is to help users of this financial information take adequate, informed, and predictive decisions. Anybody who looks at this income statement will want to see what was revenue last year. Revenue last year, total sales last year was 302,503. How much is it this year? It has grown to $339,490, meaning that revenue has increased, which is a plus for this company. The person will also want to check the profits for the year. Profit last year was 33,672, but this year profit has grown from what it was 2003 now to 41,707, indicating strength on the part of this company. So that's the more reason why we have to include the comparative figure to help users of financial information make adequate informed decisions. So here are components of accounts. The basic unit of accounting is an account or general ledger account. It is a unit of information that represents business records. So basically, there are 5 types of accounts meaning no matter the account you prepare, be it your balance sheet, your income statement, whatever it is, definitely rely on any of these 5 components of accounts, ranging from assets, liability, equity, revenue, and expenses. So the first three on the list, which is asset, liability, and equity, they are most useful for preparing the balance sheets. First three, asset, liability, and equity, we use them for preparing balance sheets. While the last two, which is revenue and expenses, they are used for preparing income statements. So a business can have anywhere from a dozen to several thousand accounts, with each one being one of the 5 types. So no matter the accounting transaction, if you want to mention them now, take for instance, a company pays wages. Wages falls under expenses, which is the last one. A company makes sales. Sales is under revenue, which is the second to last. A company buys an asset, a motor vehicle, precisely. Motor vehicle is an asset, which is under the first one. A company takes loan from NASA Microfinance Bank. That loan is a liability, which is under the second one. The shareholders make injection or contribution into the business. That is capital. Capital is under equity, which is the third one. So no matter the accounting transaction that happens within a business entity, they fall under any of these 5 techniques. And we have said that the first 3 are most useful for preparing the balance sheet, while the last 2, we use them for preparing the income statement. So accounting is the process of recording business activities that make changes to accounts. This will include sales of products. When you sell a product, you account for it. Your sales balances will change. When revenue is earned from services, you render. You discover that your revenue balance will change. When you buy products or you pay for goods and services, your purchases account will change. When you incur expenditures, the particular expenditure head will change. So as transactions occur and we account for them, we discover that accounting balances will do what? Will change. They will change. They will keep changing. So when any of these and other business activities are recorded, accounts change in value. The account will change in value. So here is double entry accounting. Recall when we are discussing the various methods of bookkeeping, we said we have the single entry bookkeeping method and the double entry bookkeeping method. And we said it categorically that if we don't have the knowledge on accounting or bookkeeping, it's expected that we maintain the single entry bookkeeping. But if we have the knowledge of the double entry, meaning we have accounting knowledge, it's expected that we should use the double entry accounting. But let me state here that this session is restricted to financial planning and bookkeeping. But in any case, if you can make attempts by understanding when a transaction happens, which account is to be debited and which account is to be credited, then it will be most useful and most beneficial. But if you cannot place the accounts to be debited or the account to be credited whenever a transaction happens, you are strongly advised to use or stick to the single entry bookkeeping method. So certain accounts are debited. When they debit them, you discover that account balance will either go up or come down depending on what the accounting transaction is. But I don't want to drag us into this debit and credit entry of a thing. Emphasis here is on bookkeeping. Ensure that your books are properly kept, such that when you maintain or keep these books of accounts, it becomes very easy for you to invite a qualified accountant, a qualified auditor, who then prepares your financial report thereof. That is the focus of discussion. And planning our finances, ensuring that your finances are planned. Don't forget the analogy we used at the beginning of this session. The man who drives a car without a fuel gauge, and you know what happens to somebody who drives a car without a fuel gauge. Just like my friend, it happened to him the other day. The gauge is not functional, and the car began to jerk. He was left in a lonely area. The car stopped. He was forced to tow the car. In fact, before he towed the car, he called a friend to assist with the fuel. And you know, most times when these things happen, they will happen in area where you cannot get fuel to refill the tank. So this same analogy applies to financial planning. Ensure that you plan your finances for your business. That will guarantee efficient and effective business processes. So on this note, I want to appreciate you and thank you for your audience. The floor is now open so that we can take questions, comments, suggestions from you. So if you have any question, I expect you to indicate by a show of hands. You can indicate by a show of hands so that we can unmute you. You go to the chats section and raise your hands. You can even drop your question on the chats box so that we can read and then provide solution or answers to it. So do we have any question? Do we have any question? Do you have question? Any question? Questions, observations, make comments. Okay.
Okay.
Okay, go ahead.
Good afternoon, sir.
Good afternoon. Who are we listening to?
This is Hilda.
Okay, Hemba.
Yes, Hemba fan.
Okay, go ahead.
Yes, please. I joined in quite late, though. From when I joined, I have gotten value, but I don't know how. Is this like the only? Okay, let me see if I can enable my video.
If this is what?
So I don't know if this is the only meeting there is going to be, or how.
Hello, Hemba.
Me.
I didn't hear you. You may have to repeat. Hello?
Hello?
Hemba, I can hear you now. I'm struggling to hear you. Hello?
Can you hear me?
Yes, I'm struggling to hear you. Even your network connection is very poor. Seen it here, but talk. Let's see if you can.
Okay, so I said I joined late. Well done. I got value from when I joined, but I didn't start from the beginning. So I want to know if this is like if there's going to be a repeat of this particular session or lecture. I don't know. I came in late. I didn't start from the beginning. So I want to know if there's going to be a repeat or not.
Okay, Hemba, you are one of the latecomers. One of the latecomers. We waited for you and we could not wait. We had to start. But there won't be a repeat of this lecture. What you can do is this video, this presentation is streaming live on YouTube. So at the end of the training session, our IT consultant will share the link on the group. So what you're advised to do is click on the link and listen to the full presentation on YouTube. It only costs you some data. Yes, everything we have said has been recorded. Reference to it on YouTube. Besides that, the lecture materials also, yes, the platform.
Okay. All right. Thank you.
So any more question? Any suggestion? Any question? Any question? Any question? Okay, if there is no more question, we'll go to the post-lecture quiz. And the post-lecture quiz, our time is fast spent. Post-lecture quiz will only last for 5 minutes. So IT consultant will share on the screen and on the WhatsApp platform the link to the lecture quiz. So it's expected that you make attempts on this quiz and submit to us. See, some of you already attempted it there, so it has been shared on the group platform. So we expect you to make attempts and return to us within 5 minutes. So exactly by 12:15, the class will be coming to an end. And I enjoin all of you to remain on this platform while making attempts. Don't abandon us. Please don't abandon us. Don't leave us. I want you to remain with us until 12:15, please. So you have just 5 minutes to send in your answers.
Where is it now?
Okay, welcome back, everybody. We have not gotten any response from you as it relates to the post-lecture quiz. But we are hoping that you turn in your answers. You have between now and the next 24 hours to do so. Please do so. Turn in your answers, your post-lecture quiz. The essence of this post-lecture quiz is to see how well you can perform. Some of us did well during the pre-lecture quiz, while some we expect you to do after the lecture. So we still expect your answers to come in. On this note, if there is, in the absence of any question, observation, or comments, we'd like to end the class to reconvene same time tomorrow by 10 a.m. The class platform will be open exactly 9:30. So that those who want to join earlier can take the front seat. So on this note, we would like to appreciate you for your attention, and I will say have a lovely day.